Inflation erodes purchasing power. This means that over time the money you have today will buy you less and less. It's a silent thief that slowly chips away at the value of your hard-earned cash. Imagine your money slowly losing value. Every dollar, every euro, every yen you hold becomes less powerful in the marketplace. It's like watching your savings melt away, bit by bit. Goods and services become more expensive. The cost of living rises, and what you could afford last year might be out of reach this year. Everyday items like groceries, fuel, and utilities see their prices climb. What you could buy yesterday costs more today. This constant increase in prices means that your purchasing power diminishes, making it harder to maintain the same standard of living. This is inflation in action. Hedging protects us. By using financial strategies and instruments, we can safeguard our assets from the eroding effects of inflation. It's a way to preserve wealth. Assets like gold, real estate, and even cryptocurrencies can act as hedges, maintaining or even increasing in value as inflation rises. When inflation rises, hedges ideally hold their value. This means that while the value of money decreases, the value of these assets remains stable or grows, providing a buffer against inflation. This helps us maintain our purchasing power. By investing in hedges, we can ensure that our money retains its value over time, allowing us to continue affording the goods and services we need. Think of it like this. Imagine you have a bag of sweets. Each sweet represents a unit of your purchasing power. Inflation is like someone secretly taking sweets out of your bag. You don't notice it immediately, but over time the number of sweets dwindles. Over time you have fewer sweets, even though you didn't eat any. This is the invisible hand of inflation at work, reducing your purchasing power. Hedging is like finding a way to protect your sweets, so you don't lose them to inflation. By securing your assets, you ensure that your purchasing power remains intact, safeguarding your financial future. Gold has a long history. For millennia, it's been a store of value. Ancient civilizations treasured gold. They used it for coins and jewelry. This precious metal is scarce and durable. These qualities make it a reliable hedge. During economic uncertainty, people turn to gold. They see it as a safe haven. When fiat currencies falter, gold often holds its value. Gold is like a comfort blanket in times of financial turmoil. Its price may fluctuate, but its long-term value has been proven over centuries. It's a tangible asset, something you can hold in your hand, which provides a sense of security. Bitcoin is a newcomer. Created in 2009, it's a digital currency. It exists solely on the internet. Bitcoin relies on cryptography. This secures transactions and controls the creation of new units. Some call Bitcoin digital gold. Its limited supply, like gold, could make it an inflation hedge. However, Bitcoin is volatile. Its price swings wildly. This creates uncertainty for investors. Imagine Bitcoin as a new high-tech safe. It's digital, secure, and only a limited number of these safes can be created. This makes it attractive for storing value, but its newness and price volatility make some investors hesitant. Gold has a proven track record, stretching back thousands of years. It has been used as a store of value, a medium of exchange, and a symbol of wealth and power across various civilizations. From ancient Egypt to the Roman Empire, gold has been a cornerstone of economic stability and prosperity. During past crises, it often held its value, providing a safe haven for investors. When markets are in turmoil, gold's stability shines through, offering a reliable refuge from the storm. The 2008 financial crisis is a good example. As the stock market plummeted and financial institutions crumbled, gold's price surged, reflecting its role as a trusted asset in times of uncertainty. Gold's price surged as investors sought safety. This pattern has repeated itself throughout history, reinforcing gold's reputation as a dependable store of value. Bitcoin's crisis performance is limited. Unlike gold, Bitcoin has only been around for a little over a decade, and its behavior during economic downturns is still being observed and analyzed. It was created after the 2008 crisis, born out of a desire for a decentralized financial system. Its creation was a direct response to the failures of traditional financial institutions. Its reaction to recent events is mixed. In some instances, Bitcoin has shown resilience, while in others, it has mirrored the volatility of traditional markets. In some cases, it correlated with stock market drops, suggesting that it may not always serve as a hedge against market downturns. In others, it acted as a haven, attracting investors looking for an alternative to traditional assets. This duality makes Bitcoin's role in financial crises complex and multifaceted. More data is needed to assess its long-term viability as a hedge. As Bitcoin continues to evolve, its place in the financial ecosystem will become clearer. It's like comparing a seasoned sailor who has weathered many storms to a novice sailor on their first voyage. Gold, with its extensive history, is the seasoned sailor. Gold has navigated countless economic storms, proving its resilience and reliability time and again. While Bitcoin is still learning to navigate the turbulent seas of finance, its journey is just beginning, and only time will tell if it can achieve the same level of trust and stability that gold has earned over millennia. Predicting the future is difficult. Both gold and Bitcoin have strengths and weaknesses. Gold's long history provides confidence. However, its physical nature can be cumbersome. Bitcoin's digital nature is appealing. It's easy to store and transfer. But its volatility raises concerns. Which will be the better hedge? Only time will tell. Imagine two paths diverging in the financial forest. One path, well-trodden and familiar, leads to gold, the traditional safe haven. The other, less traveled and unpredictable, leads to Bitcoin, the digital frontier. Which path will lead to greater financial security? The answer remains uncertain. One of Bitcoin's key advantages is its decentralized nature. This decentralization is not just a technical feature, but a fundamental principle that underpins the entire Bitcoin ecosystem. It means that Bitcoin operates without a central authority, unlike traditional financial systems that rely on central banks and governments to regulate and control the currency. Unlike traditional currencies controlled by governments and central banks, Bitcoin operates on a distributed network. This network is made up of thousands of nodes, each of which holds a copy of the entire blockchain. This ensures that no single entity has control over the network, making it more secure and resilient to attacks or failures. This means no single entity can manipulate its supply or value. The supply of Bitcoin is fixed at 21 million coins, and this scarcity is built into the code itself. This is in stark contrast to fiat currencies, which can be printed in unlimited quantities by central banks, leading to inflation and devaluation. This decentralized structure makes Bitcoin resistant to government interference and inflationary policies, making it an attractive hedge for those concerned about the stability of traditional financial systems. In countries with unstable economies or authoritarian regimes, Bitcoin offers a way to protect wealth from confiscation or devaluation. Think of it like this. Gold is stored in physical vaults controlled by governments and financial institutions. These vaults are secure, but they are also centralized points of control. If a government decides to seize the gold, it can do so relatively easily. Bitcoin, on the other hand, is like a digital treasure chest, with keys distributed among a global network of users, making it resistant to confiscation or manipulation. Each user holds their own private keys, which are necessary to access their Bitcoin. This means that even if one part of the network is compromised, the rest remains secure, ensuring the integrity and security of the entire system. Bitcoin's price volatility can be daunting for some investors. Its value can fluctuate significantly in short periods. However, this volatility is also a reflection of its novelty and growing pains as a nascent asset class. As Bitcoin matures and gains wider adoption, its volatility is expected to decrease. Moreover, savvy investors can leverage this volatility to their advantage through strategies like dollar-cost averaging, mitigating risk, and potentially maximizing returns. Imagine Bitcoin as a young sapling. It may sway violently in strong winds, but as it grows, its roots will deepen and its trunk will thicken, making it more resilient to market fluctuations. Ultimately, The best hedge against inflation is a diversified portfolio. Don't put all your eggs in one basket. Instead, spread your risk by investing in a mix of assets, including gold, Bitcoin, real estate, stocks, and bonds. Each asset class has its own risk and return profile, and diversification helps to mitigate overall portfolio volatility. Think of your portfolio as a garden. Just as a diverse garden is more resilient to pests and weather conditions, a diversified portfolio can better withstand economic shocks and market fluctuations. The debate between gold and Bitcoin as the ultimate inflation hedge is far from over. Both assets have unique properties and potential benefits. Gold offers the stability of history and tangible scarcity. Bitcoin presents the transparency, security, and freedom of decentralization. Ultimately, the best approach for individual investors depends on their risk tolerance, investment goals, and understanding of these evolving assets. As we navigate the complex and ever-changing financial landscape, knowledge and careful consideration are paramount.